All right, welcome back. On to the next unit. We're now in Unit 5. We just covered fiscal policy, and this unit is entitled Money, Banking, and Monetary Policy. And in this first screencast, I'm just going to introduce where we're going and introduce you to an institution called the Federal Reserve Bank. Alright, so what we've seen so far is that fiscal policy involves the Congress and the President trying to change aggregate demand and therefore change how the economy is, GDP, unemployment, and inflation, by changing two tools, taxes and government spending. What we're going to see is that monetary policy is a different institution called the Federal Reserve that's also trying to change aggregate demand and therefore change GDP, unemployment, and price level through changes in the money supply. So essentially what we have here is a different institution with different tools pursuing exactly the same goal as we saw before. So we're going to talk about how monetary policy works. We're going to talk about how the institution differs from Congress and the President. And we're going to talk about how they try to achieve the same kind of goal. Now, eventually where we're going is exactly where we came from, this aggregate demand, aggregate supply graph. We saw that fiscal policy is about trying to push aggregate demand to the right spot in the graph. So if there's a recession, trying to push aggregate demand to the right, and if there's inflation, trying to push aggregate demand to the left. We're going to see the same exact thing here. The Federal Reserve is going to be trying to push this aggregate demand curve around. It's just going to do it in a different way that Congress and the President were trying to do it. So as we go through this unit, we're going to go on a little journey. The journey is going to start with an exploration of what money is. We're then going to have to take a look at banks and see how banks operate. And what we're going to find is that banks can actually create money. The Federal Reserve uses this idea, uses this technique or process of banks creating money to change the money supply in the economy. And by changing the money supply in the economy, what we're going to see is that they're going to be able to change aggregate demand. So a little foreshadowing here, and this is essentially where we're going over this next unit. We're going to see that by changing the money supply, the Federal Reserve is going to be able to change interest rates. And we've already seen, both leading up to the aggregate demand, aggregate supply model, and also when we talked about the crowding out and net export effects, that changing interest rates can change investment, and it could also change the amount that consumers spend. If investment and consumer spending changes, aggregate demand changes, and if aggregate demand changes, the economy changes. That's essentially the layout of where we're going and the process that's going to happen through the Federal Reserve changing the money supply. Again, the entire unit is going to be basically about going through how this process works exactly. Now, the institution that we're going to be talking about is called the Federal Reserve Bank, which is a central bank of the United States. Now, actually, there's 12 Federal Reserve banks, each one placed in different parts of the country that monitors the economic activity in different parts of the country. And it performs a central bank role. It's essentially the Bank of the United States divided into 12 separate parts. Not unlike the Bank of Japan or the Bank of England, the difference in the United States is that we divided up and separated out throughout the country. They're quasi-public banks, which means that they are public institutions. They are thought of as part of the government. On the other hand, they're owned by the banks in their district, which makes them quasi-public. They're kind of this like public entities, and they're kind of private entities. And they're also considered to be bankers' banks. Just like Wells Fargo might be your bank, the Federal Reserve might be the bank for Wells Fargo. So what they did back in, I think, 1913 is divide the country up into 12 separate districts and place a Federal Reserve Bank in each one of those districts. You can see ours is the 9th district, and the Federal Reserve Bank for our district is located in Minneapolis. This is a way to kind of deal with the fact that different parts of the country have different economies at any given time. The West might be doing better than the Southeast, and so forth. Now, the Federal Reserve Bank is run by a board of governors. Those are 7 members appointed for 14-year terms, and the fact that they're appointed matters. They're not elected, so they don't have to deal with political pressure once they're working in office. And then out of those 7 members, they pick one president of the Federal Reserve who's appointed for a 4-year term. So you'll notice that these people are unelected and they have relatively long terms. This is to ensure that they're going to be politically independent and not constantly running expansionary policy, for example, like the government does, simply because that's politically popular. Now, there's a group within the Board of Governors called the Federal Open Market Committee. It's the Board of Governors plus 5 of the presidents of the Federal Reserve banks around the nation. So together, the Federal Open Market Committee is kind of the policy-making board of the Federal Reserve. They take all of the boards of governors, they pick 5 out of the 12 presidents of the regional Federal Reserve banks, and they go about doing what the Federal Reserve does. Now, just so you can connect this to some recent history, here's the 2 most recent presidents of the Federal Reserve Bank. The guy on the left, his name's Ben Bernanke. He's the president right now. The handsome devil on the right, his name is Alan Greenspan. He was the president of the Federal Reserve Bank before Ben Bernanke came around. Now, I'm pretty sure that Alan Greenspan is married, so I know you're disappointed. I'm not sure about Ben Bernanke, so ladies, you might want to line up. He may or may not be married. Someone might want to look into that. So these people get together at a big table and they think about the economy and they pursue their various obligations and responsibilities. The responsibilities of the Federal Reserve Bank include a few things that we won't care about so much and one thing that we really will. The first thing they do is issue currency. This is where all the currency in the country comes from. It comes, at least originally, from the Federal Reserve Bank. Secondly, they set what are called reserve requirements, which we're going to be talking about over the next couple of screencasts. That's a requirement for banks to keep a certain amount of money in their vault, and we'll talk about why that's important in a bit. They lend money to banks when banks need money, and sometimes they do. We'll talk about that. They supervise banks to make sure that banks are doing the right thing and not absconding with people's money. But most importantly, they control the money supply. They decide how much money is out there in the economy. And the process by which they take money out of the economy or put money into the economy is really important for monetary policy, and we're going to be spending a good amount of time talking about that as well. All right, that's the introduction. I will see you next time as we talk about what money is, the nature of money, and the fact that money may be just an illusion. See you then.
Damn it, this is too hard! Here's what I think of your test, Mr. Teacher!